Great having you with me for another live strategy session. Thanks for joining me. Lots of interesting things to talk about. New all-time highs in the S&P 500, the local market just continuing that pullback from the last couple of weeks. Also, plenty going on in gold, copper, oil, and uranium. We're going to get to those a little bit later on. And of course, any stock codes you have, get them ready. We're going to go through those at the back end of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And we're going to start off with the ASX 200. And so the index has stabilised this week. It's stabilised around the 50-day moving average. And that follows the biggest decline in 5 months. So is this a sign that the pullback is over and are new all-time highs on the way? I'll tell you what I'm doing around that in a moment. And then over in the US, we'll look at in a minute. The S&P 500, it's just hit new all-time high. I've got an extraordinary graph that I want to show you. I actually had to look at the dates twice to believe what I was seeing. I'm going to show you that in a few moments. I think you're going to be as amazed as I am at what you see. But before we get to that, let's start off with this latest price action in the ASX 200. So there hasn't been a great deal of movement in the index this week. Prices have traded within this tight range, just above the September low. And of course, that coincides with the 50-day moving average. Below there is the 100-day moving average. I think the price action we're seeing here, I think it's positive. I think it's positive price action, and it's a sign that the dip is being bought. I think the fact that prices are consolidating near the 50-day moving average, that's a classic bullish sign. And the reason I say that is that bull markets are built on a series of rallies that take prices up and away from the moving averages, and then followed by consolidations where prices return to the moving averages. And you can see that price action playing out many times over. You can see it in the last big bullish phase during 2024, and you can go back to earlier ones, and see it there as well. The big rallies, the pullbacks to the moving averages. It's a well-known series in a bullish phase. I think that same sort of pattern could be playing out now with this latest pullback to the 50-day moving average. And I think that understanding this natural flow of the markets can help us ride out the pullbacks and stay on trends when they appear. And that was a key to staying on the big trend in 2024. It's like above rising moving averages, pullbacks, staying on the trend. The same process is what I'm aiming to do now as well. All too often, I hear of people talking about trying to call tops. Like it happened all the way during 24. People are trying to call tops the whole way up, and then they'll often worry that is a pullback the start of a bigger decline. But in a bullish phase, the odds favour that these pullbacks are temporary, and then that new highs will prevail. And until we have signs to the contrary, for me, that would involve like prices trading below declining moving averages. Until we get that sort of setup, whilst prices remain above the rising moving averages, for me, it's a case of the base case being that this remains a bullish market. I said last week that I thought a multi-week consolidation was possible, and there's still certainly scope for such a period of price action to develop. But the rally could also just as easily re-engage from near current levels in the near term. For me, it's a case of being mentally prepared for a longer pause, but also being positioned for further upside should it happen sooner. And this is the thing, that the timing of consolidations, they're always uncertain. So yes, this could chop sideways for several more weeks, even several months. Like you can't rule out something similar to what we saw back down here in the middle part of 2024, where prices went sideways. So it got above those moving averages, came back to the averages. So this isn't too dissimilar to where we are now. But then you get that sideways that goes on for several weeks or maybe several months. That's a possibility. That's always a possibility in with where things are now. But it could also just be like a touch and go. The move comes back, touches the averages, and goes again. So you don't know. We never know which one. Never know which one we're going to get. So I think the best approach is it's to maintain exposure, use those wide trailing stops to try and see off the pullbacks. And by doing that, I'm ready for further upside should it come in the near term. And I can patiently sit if it takes time to consolidate and move sideways to maybe a bit lower. And I've also got that exit plan in place should prices break to the downside, get below the moving averages and start trending lower. So there's an exit plan as well. So it's really a plan for whatever happens next. The last thing I want to do is sitting it out, hoping for a pullback in order to buy. I think anyone who's been doing that over the last few months, well, I think that's been a pretty frustrating way to approach the market. And it can be really difficult being out of the market, hoping for a pullback and just seeing prices continue to advance. That can be a difficult thing to do. I'll show you another reason why I think the latest pullback is simply a pause in the trend. Let me jump over to the equal weight, ASX 200 on an equal weight basis. And it's interesting when we look at this. So when we look at what's going on in the equal weight, look at its performance over the last couple of weeks. So far, this has been a shallow pullback, and as we often discuss, shallow pullbacks are often a sign of buying interest. So that's how the equal weight is shaping up at this point. And you'll also notice it hasn't returned to its 50-day moving average, unlike the ASX 200, which has. So this is a sign of relative strength in the equal weight compared to the ASX 200. And it shows that the broader market, it's really holding up very well during this what has been for the ASX 200 the largest pullback since the largest multi-day pullback since the April low. As we discussed, as we often discuss, I think like a strong broader market is a key factor in sustainable bullish phases. And I think the time of most concern is when we get those narrow rallies, like a few big caps really pulling the market higher, doing all the work. That's when I can get concerned. But that's not what we have here. This is a broad-based rally in those ASX 200 stocks. There's plenty of room for this to consolidate. Like, you look at this and it is elevated above the moving averages. There's certainly room for consolidation. For example, we could see several weeks of sideways price action while the moving averages catch up. But the underlying trend here is bullish. We've got rising moving averages. The 50 and 100-day moving averages continue to trend higher. Prices above those moving averages. So I think when you consider that, the odds favour higher levels in the coming months. Just coming back to the ASX 200 for a moment, whether we see gains come in the near term with a rally off the 50-day moving average, or whether it's that scenario of sideways chop for several weeks or so. Like, we can never be sure which one it's going to be, but that's not an important factor for me. It's more about being positioned for a bullish trend. And from that perspective, I'm long the ASX 200 index. I'm long the individual stocks. Like outside the ASX 200 primarily, I'm long like a lot of those emerging companies and smaller ordinaries type stocks. And again, I'm managing risk with those wide trailing stops. I think while the markers are all bullish now, well, as far as I can see, they're all bullish now, we know that's going to change at some point. So we should always have a plan to exit in mind. But at this point, it's an upward trend. Now, we're going to move over to the US market in a sec, but first of all, if you're getting some value from this, please hit that like button, leave us your comment, tell me what you think. Is the market going to make new highs in the near term, or are we going to see consolidation? And those things help me a lot. When you do that, I can see what you're thinking. I can, it tells YouTube that you're engaging, and yeah, click that like button. It really does help a lot. All right, let's move over to the S&P 500. And strong upward movement in the US market this week. New all-time highs in the S&P 500 as well as the Dow and the Nasdaq. And in terms of the S&P 500, Thursday's high was the 22nd all-time high for this year. So that series of all-time highs, as we talk about, all-time highs tend to lead to more all-time highs. So that series has continued to evolve. I've got a graph I'll show you in a moment. It brings a fascinating perspective to what's going on with this rally. But before we do that, just look at the price action here first. The break to new highs, well, it follows about 3 weeks of consolidation. I'm going to go to the Dow. I think you can see this consolidation better when we look at a picture of the Dow. It stands out more. And so here it is here. Here's the Dow Jones. And so what we've got here, we've got a break to new highs a few weeks ago, and then that followed 3 weeks of consolidation. 3 weeks of consolidation came after that, and then from there, and that consolidation was just above this support, this big support, or not big support, but a support around 45,000. And then from there, we got a break higher on Thursday, taking things to a new all-time high. So we spoke about the Dow last week, and I discussed the stepping pattern that you can see on this chart. And this is where prices rally, and then you get the consolidation back towards the moving averages, another rally, the consolidation into the moving averages, and so on. And prices are just starting to step higher again with last night's or with Thursday's price action. And I think we can also see, you can see we can see that sequence continuing this week with that next step higher. There's also been similar price action in the equal weight. So let's go over to the S&P 500 on an equal weight basis. And you can see all that happening here as well. So prices have just broken to a new all-time high on Thursday. And that follows 3 weeks of sideways consolidation, just like in the Dow. The key feature on this chart remains those rising moving averages. So the 50 and 100-day moving averages continuing to trend higher. Of course, prices above the moving averages. So it's that clear, classic bullish structure. You'll also notice a clear sequence of rising lows and rising highs. So another bullish marker. I think the fact that the equal weight is breaking to a new all-time high, I think that's positive. And that is, it's not just about what we know as the Magnificent Seven. It's not just those big mega caps which are rallying. The rest of the market is also moving higher. So when we get the big caps rallying and the rest of the market struggling, it's not always the strongest sign for the market. But what we have here, this is a broad-based bull market with rising participation, and broad participation is a sign of a healthy bullish market. I saw some really interesting research during the week. It looked at periods where the S&P 500 had a 4-month winning streak, and then prices finished that period at a record monthly high. So just again, a 4-month winning streak where prices then finished the period at a record monthly high. So since 1980, there have been 21 such periods, and 12 months later, the S&P 500 was higher in 18 of those 21 periods. And of course, we've just finished a period like that just now, 4 consecutive monthly rises with prices finishing the last month at a record high. Now, there were 3 periods where prices weren't higher a year later. So 18 were higher, 3 weren't. Two of those periods were down by about 1%. The third was down 20%. That was 1987, the 87 crash. But the average for the 12-month returns following a period of those strong gains was 14.2%. Now, some interesting points about that. So that's not to say we're going to see the same thing happen in the next year because of that, that we've just come out of that 4-month sequence of rising prices. Some important points. Each period had sell-offs and consolidations of varying magnitudes over the next 12 months. So it wasn't a case of just leveraging up and watching the gains flow in. Risk always needs to be managed. So always got to understand that. And of course, the past doesn't predict the future. So just because something worked before doesn't mean it will work again. So it doesn't mean that next year has to be up just because we've got this long history of that happening in the past. But I think what it does show is that exceptional performance, like we've seen in the market, just coming back to the S&P 500. So exceptional performance, as we've seen, isn't a good guide to impending trouble, because that's what a lot of people think. That people think a big run is a sign that it can't keep going. There's got to be trouble ahead. So yes, things can go wrong as they did in 1987, but more often than not, strong performance is not a bearish signal. And that brings me to the graph I want to show you now. So this is the AAI Investor Sentiment Survey, so the American Association of Individual Investors. I showed you this a couple of weeks ago, but the latest results are just astonishing. So the latest results is this top bar in the graph. So it's from a couple of days ago. It was released. Now, what this tells us is that as of this week, 49.5% of respondents are bearish about stocks in 6 months' time. So this is a question: what do AAI members feel about the stock? Feel the stock market will be in the next 6 months? 49.5% are bearish. Now, just think about that. The market's hitting all-time highs, yet half of the AAI members are bearish. In my experience, that's not how bull markets end. Bull markets typically end when most people are optimistic, if not euphoric, about the potential for higher levels. And people talk about things like new eras. They talk about new technologies being this great driver of growth. And they say this time is different to other periods. That's not what I'm seeing around at the moment. When I look at surveys like this, where just about half the respondents are bearish, it's not what we typically see at market tops. I don't think there's ever been a bear market where half the people are cleverly waiting and ready for things to come apart. If anything, a packed out sideline often provides the fuel for higher levels. So it's interesting when we combine that with what I was just telling you about a big sequence of rising months at all-time highs. So anything can happen, but it's interesting to take all that information on board. I continue to believe it's a case of staying long stocks. The overall structure here is bullish, and I think the path of least resistance remains up. Yes, there'll continue to be pullbacks for as long as the trend remains in place, but until I've got a good reason to do otherwise, I want to stay with this trend for as long as possible. Okay, so having been through the local stocks and the US market, let's now jump over to the small caps. Start with the US small caps, go on to the Aussie small caps after that. But of course, that wraps up the free section. If you're not a Strategy Session member, link below, come on board. Doesn't cost you very much. A whole lot of things we're going to go through: the small caps, the commodities, all the individual stocks, anything you might want to ask. So yeah, think about doing that. And having said that, I think we'll get into the Russell. So start off with the Russell 2000, the US small